Fair value gaps, order blocks, volume imbalance. A lot of you are familiar with this ICT concept, but still you don't know how to apply them in your charts. In this video, I'm going to be showing you a very decent ICT strategy, which is called the ICT Trend Continuation strategy. I've backtested this strategy for a while now, and it is safe to say this strategy has an 85% win rate. Without further ado, let's get straight into the screen. So as the case of other strategies, we are going to be looking at a buy example and a sell example. So for the buy example, we want to see price moving in an uptrend, right? The trend is your friend. You want to be buying in an uptrend. So if you want to trade this strategy, the first thing you want to look out for is a break of structure right here. You want to look out for a break of structure right here. Now, when you see that break of structure to the upside, you want to look out for a fair value gap that price has left behind before breaking that structure to the upside. Most of the time, when price breaks structure, price is always going to retrace into a fair value gap. Price is always going to retrace into a fair value gap or a level of inefficiency in the market to fill out that level of inefficiency or that level of imbalance before moving in the opposite direction. Then you look for a fair value gap. You're placing your buy right here, stop loss maybe below the previous low, and then targeting a risk to reward of 1:3, right? So that's basically how this strategy works, the ICT Trend Continuation strategy. Let's take a look at an example in the real charts. All right, so this is GBP USD, and this is the 30 minutes time frame, as you can see right here. So without anybody telling you, you can see that we are in an uptrend right here because we are constantly breaking structure to the upside. You can see it's right here, break of structure, break of structure. Now, like I said, the first thing you want to wait for when you are trading the ICT Trend Continuation strategy is you want to wait for a break of structure, right? So first, we want to wait for price to break this structure right here, a break and a close above this structure right here. Very good. So now what can we see right here? Price has broken this structure to the upside, a break and a close above this structure to the upside. Now, what is the first thing we want to be looking out for? We want to be looking out for our fair value gap that we are going to use as our entry, right? This is our fair value gap right here. You can see it. There's no overlap between the high of the first candle and the low of the third candle. So there's a fair value gap right there. So we want to wait for price to retrace into this fair value gap, which we are going to use as our entry, and then we are going to start targeting the highs. All right, let's watch how that plays out. Immediately price does this retracement into our fair value gap, we are going to place a market execution order for buy in the 50% retracement level of this fair value gap, with our stop loss slightly below this low right here, targeting what? A risk to reward of 1:3. Now let's see how that plays out. Price has smashed our TP for 100 pips right here. So you can see how easy it is to apply this strategy. First of all, we saw a break of structure to the upside. We identified our fair value gap. When price did this retracement into our fair value gap, we took a buy, stop loss below this low right here, and TP straight for a risk to reward ratio of 1:3, and price smashed our TP. As easy as that. So let's look at the sell example. In the sell example, you want to be in the downtrend. First of all, you want to be in the downtrend. You want to be breaking what? You want to be breaking structure to the downside. Breaking structure to the downside like this. Now, the first thing you want to see when you want to take your entry is you want to see a break of structure. First of all, when price has broken structure to the downside, the first thing you want to identify is your fair value gap that you are going to use as your entry or your order block, which is going to be somewhere above right here. It's always going to be in the premium zone for the sell setup. Price is going to retrace into a fair value gap or another block in the premium zone, which you are going to use as your entry for the sell trade. It's going to be something like this. You sell right here, stop loss above the previous swing point, and then your take profit is going to be a risk to reward of 1:3. Let's take a look at an example in the real charts. All right, this is SAU USD or gold, and you can see without anyone telling you, we are gradually breaking structure to the downside. You can see break, 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 right? Break. And now we want price to do what? We want price to break this structure to the downside right here. This structure that price just created. We want price to break this structure to the downside. As you can see right here, price has broken this structure to the downside. Before you start complaining, I know we can see that there are a lot of fair value gaps right here. There's one right here, and also we have another one right here. Now, which fair value gap should you be using for your sell entry? If we divide this zone into two, we have our discount zone at the bottom and our premium zone at the top. Now, if you want to be taking a sell, you want to be selling from a premium zone, right? You must have heard that from your mentor or anybody else. You want to be selling from what? You want to be selling from a premium zone. That means price is going to disrespect this fair value gap, trade into the premium zone, fill out this level of inefficiency in the market before we see distribution to the downside. So what do? We place our what? We place our sell limit order in the 50% retracement level of the fair value gap with stop loss above the swing high, targeting a risk to reward ratio of 1:3. Right? It's as easy as that. We took a loss right here. Although price traded down into our direction for some time, we saw price consolidating and then price broke to the upside before hitting our stop loss. As a technical analyst trader, if price does this, you should be leaving your trade. You can see the first bottom, second bottom, third bottom. Price is giving you a triple bottom pattern, so you don't want to even be in this trade anyway. It means price is struggling to continue going lower. Although if we are targeting a risk to reward ratio of 1:2, price would have hit our TP before moving to hit the stop loss. But then I'm just trying to use this example for you guys to show you guys that because you're targeting a risk to reward ratio of 1:3, price is not going to hit your TP all the time, right? Price respects structure a lot, and price is supposed to be going down to hit your TP. But then when you see this kind of movement in the market, you don't want to be in this trade anymore. This is actually a sign that price is going to start reversing against you. All right, so that's the ICT trend continuation strategy. Backtest this strategy and you'll be surprised how your trading is going to improve. If you gain value from this video, leave a like, and if you have a question, leave it in the comment section. I'll try my best to attend to all the questions.